Hello everyone, and thank you for tuning into our webinar. My name is Pierre Wong, Managing Director of Integra Group. Today we are talking about profit repatriation strategies for foreign enterprises in China. As you may be aware, China is a foreign currency control country, meaning that foreign investors will face a series of compliance challenges before they can successfully send profits back home. First, a little bit about Integra Group. Integra is an accounting, tax, HR, and corporate advisory firm servicing primarily foreign enterprises in Asia. We are headquartered in Shanghai and have offices in Hong Kong, Beijing, Singapore, and Taipei. Before Integra, I served as a head of Shanghai for KCS, now known as TMF Group. I also served as a finance director at CB at Richard Ellis and a senior manager at KPMG Shanghai office. Today, I will share with you the four primary methods that foreign investors can use to repatriate profits back to their home country, and the tax liability of each method. These methods include dividends, service agreements, royalties, and foreign loan interest payments. We will also talk about the implication of transfer pricing, something which foreign investors need to be aware of if they hope to use some of the methods we are going to discuss. Dividends are the most common method of repatriating profits in China. Naturally, if a company is earning a profit, they are allowed to remit those profits back home to investors. However, there are some caveats when it comes to paying dividends, which we will discuss. First, only after-tax profits are eligible for dividends. Companies must pay the standard corporate income tax, which is generally 25%, on any profits they earn. According to China tax law, all companies must put an additional 10% of their after-tax earnings in a special capital reserve account. The capital reserve funds stay within the company, but are not eligible for remittance. Lastly, when remitting profits overseas, the China company is required to withhold an additional 10% withholding corporate income tax before they can finally repatriate profits. Some double taxation avoidance agreements provide a lower rate for withholding tax. For example, the double tax agreement between Hong Kong and China reduces the rate from 10% to 5%. So, under normal circumstances, the net amount of profits that can be repatriated is about 60.75 for every 100 RMB of profits earned. One thing I would like to mention as well is dividends are much more tax efficient for micro and small enterprises in China. Micro and small size enterprises only pay 5% corporate income tax on the first 1 million RMB of profits. Between 1 million to 3 million RMB of profits, the corporate income tax rate then becomes 10%. After the first 3 million of profits, they will pay the standard 25% corporate income tax on all the profits above the threshold. What this means is that dividends become a much more tax-efficient method of repatriating profits under 3 million RMB for micro and small-size enterprises. Now let's look at the process for remitting dividends. First, the company can only use after-tax profits for dividends, so they must complete the annual tax return filing and conduct an annual audit by a local CPA firm. This is usually done before June of the following year. The second step is the executive director or board of directors drafting a profit distribution plan. A board resolution will be passed by the directors of the company to determine the amount of profits to be distributed back to the parent company. Next, the company should withhold the necessary corporate income tax to pay to the Chinese tax authorities. If the host country has signed a double tax agreement with China, the company can apply for the reduced withholding CIT. And finally, once the necessary taxes have been paid and all required documents are prepared, the company can go to the bank and make the remittance. Now, we will go over some additional considerations regarding dividend repatriation. First of all, you cannot repatriate your annual profits until you have completed the annual tax filing in June of the following year. This means that you can't provide funding quickly if investor or the parent company is in need of cash. Secondly, the company must have fully topped up its registered capital. You can think of registered capital as a promise by the business to invest the capital amount into the Chinese economy. You cannot pull money out until you have fulfilled your promise to invest the capital amount. Chinese tax regulation also prevent you from remitting 100% of your after-tax profits back to the investors. The capital reserve requirement ensures that companies in China reinvest at least 10% of their profits back into the business, unless they accumulate 50% of their registered capital. This essentially becomes like a very large rainy day fund. If the business wants to reinvest the capital reserve in the business, they can do so by increasing the registered capital by the reserve amount. They are then free to use these funds to pay salaries, pay rent, or any other operation costs. Now, let's look at some alternative methods for foreign enterprises to repatriate profits. It is often the parent company to provide services to its subsidiary in China without even realizing it or even charging the subsidiary for their costs. For example, the parent company might provide marketing services or design services or other kinds of supporting function at the group level. In these circumstances, the Chinese company is permitted to pay the parent company as a service fee. Service fees paid by the Chinese company to an overseas entity are subject to a withholding value-added tax of 6% and the related local surcharges. Local surcharges in China is a percentage of VAT and vary between cities. So for this example, we use a baseline amount for Shanghai. Service fees also subject to the standard corporate income tax of 25%. And depending on the service type, the corporate income tax is based on the deemed profit rate in the range of 15% to 50%. However, for most types of services like marketing and design, a deemed profit rate of 30% is used. So after all the taxes, you can see the net amount for profit repatriation is 86.58 for every 100 RMB of service fees for remittance. One thing to note is that the withholding corporate income tax paid in China can be deducted from the corporate income tax of the parent company overseas if there is a double tax agreement signed between the host country and China. Now let's look at how to pay intercompany service fees from China. First, it is important that the company prepares a contract between the Chinese company and the overseas counterpart. They should prepare any additional documentation related to the service fees like invoices and timesheets if possible. Next, if a double tax avoidance agreement signed between China and the host country grants any tax exemptions or preferential tax treatment, the China company can apply before making the withholding tax filing and payment. For service fees under $50,000, Chinese tax authorities no longer require the China company to withhold taxes before the remittance. Instead, they can complete the tax filing within 30 days of remittance. And lastly, step 4, the company can go to the bank and send the money overseas. I should note that since Chinese authorities have eased some of its foreign exchange regulations, the bank are required to do their own due diligence. So they will request various documents related to the transaction before remittance can be made. Now, let's talk about some of the other considerations regarding intercompany service fees. Services that are provided entirely outside of China are eligible to be exempted from VAT and CIT. However, if the company chooses to not withhold these taxes before repatriating profits, it should be confident that it can prove that the services were provided entirely outside of China, and it should expect to defend its position when challenged by the tax authority. Next, companies are no longer required to re-register foreign service contract with the State Administration for Foreign Exchange. The government authorities have put the burden of due diligence on the banks to inspect the details of the transaction before remitting funds. And lastly, when deciding whether to charge service fees to the China company, you should first be very clear whether those service fees constitute a permanent establishment or PE. A PE is triggered if an employee is working on a project or related project inside China for more than 183 days, or if the service delivery lasts more than 12 months. If the services provided constitute a PE, then those services will be taxed as if they were a separate standalone company and taxed at a standard rate of 25%. The compliance burden becomes much bigger as they will need to collect all the associated costs and prepare more detailed information to file with the China's tax authorities. This doesn't always mean a greater tax liability. It comes down to many different factors. But the company should be very clear when it is creating intercompany service fee whether the services will trigger a PE. Now we'll look at royalties. Royalty is a fee paid in exchange for the use of intellectual property, such as trademarks, patents, or proprietary technology. If your company in China is using a trademark or any intellectual property belonging to your parent company and are not already paying royalties, then this is another way to the company be repatriating profits back to its parent company. Royalties are very similar in terms of tax efficiency as service agreements. They are subject to 6% VAT and local surcharges, as well as the standard 25% corporate income tax. However, royalties are always taxed based on the deemed profit rate of 40%. This is fixed, so you will often hear accountants refer to it as a flat 10% income tax rate. It's a good idea to look into any trademark or intellectual property you might be using and whether they can be a means of repatriating profits overseas for your company. In order to pay royalties to an overseas entity, the company should start with preparing the contract and the contemporaneous documentation. For intellectual property, you will want the overseas trademark filing or patent registration on hand. It is not necessary to register the intellectual property in China, though this might be a good idea anyway if you haven't already done so. But you will need to register the contract with the trademark office if you are paying royalties in exchange for the use of a trademark, or register the contract with the local Commerce Bureau if you are using a patent or some form of imported technology. Next, as with dividends and service agreements, the company may apply for preferential tax treatment if it is provided under a double tax agreement. The company should then calculate all the withholding taxes and make payment if necessary. And finally, they are able to make the remittance with the bank. Some other things to note about royalties is that royalty agreements, as well as most of the intercompany transactions, must be carried out at arm's length. We'll talk more about that in just a bit, but it is important to note the royalties as their intangible assets. The Chinese tax authorities' view on royalties is the fees paid in exchange for the use of intellectual property should be equal to the value the company creates from the use of that intellectual property. It is important, if you are paying royalties to an overseas company, that you use an acceptable method of determining the pricing and include that in the contract. The last method we will discuss is foreign loan interest payment. This method is more determined by the overall plans of the company and can be considered as a tax planning measure. Two ways a company has to provide funding to its company is either through increasing the registered capital or by providing a loan. There are many benefits for providing a loan instead of increasing the registered capital, one of which is the China company can pay interest to the issuer of the loan. They are taxed as the same way as royalties. Interest payments are subject to 6% VAT and local surcharges, as well as the standard corporate income tax rate of 25%. As with royalty fees, the deemed profit rate is fixed at 40% as well. Here we have the process for foreign loans and interest payments. Companies generally cannot register foreign loans after the fact. This is more of a proactive tax planning measure that companies can take either when they are setting up their company or when providing new funding for the company to expand the business or cover losses. First, the company must prepare the intercompany foreign loan agreement with the parent company. The loan agreement must be registered with the State Administration for Foreign Exchange and must be approved before the company can actually receive the foreign funds. Next, the company must open a special foreign loan bank account in which the funds are deposited. This is so that the State Administration for Foreign Exchange can monitor how the loan is being used. Once the foreign loan is set up, the interest payment process is very similar to the other methods. The company can apply for any preferential tax treatment provided under a double tax avoidance agreement if one exists. They must then withhold the necessary taxes and pay to the relevant authorities before making the final bank clearance and remittance. So, for interest payments, there are some additional considerations. The interest rate at which the China company pays to the loan provider cannot be higher than the official interest rate offered by Bank of China. This is generally around 4 to 4.5%. And there are additional restrictions on how much foreign debt a company in China can take on. This is known as the foreign debt quota. In China, companies often only talk about the registered capital. However, companies can declare a total investment which is greater than the registered capital. The difference between these two is the foreign debt a company is allowed to take on. To determine the foreign debt quota, you simply take the total investment minus the registered capital. You can see in the table at the bottom the registered capital requirement as part of the total investment. If you are a new investor, you can look at the total amount of the capital as the total funding you need for your business to get it self-sustaining, and then register a portion of that as a foreign loan based on your allowed amount. This creates more options for you down the road to repatriate profits both in the form of interest payments and returning a portion of the principal back to the investors. If you are an existing business and require additional funding for the future, consider a foreign loan rather than increasing the registered capital. Now we'll move on to transfer pricing implication in China. Transfer pricing is a term used for the exchange of goods or services between two related companies or parties. Transfer pricing has become a key topic for multinational companies due to the OECD base erosions and profit shifting framework. The base erosion and profit shifting framework is an initiative between 135 countries, including China, to prevent tax avoidance and provide a more transparent tax environment. One of the key principles is the arm's length principle. The arm's length principle basically states that the conditions and pricing of goods and services between related parties must be the same as if the parties were not related. There's various tools and methods that accountants and financial institutes use to determine what is fair pricing. Some of the more common methods are the cost-plus method, which is a simple cost plus a standard profit margin on top. Companies can also justify the pricing using the retail price method, which using a market price for the goods or services provided. There's also the profit split method, where the company determines how to allocate the profit between the two related companies. The key takeaway here is that when engaging in intercompany transaction and transfer pricing, companies should take steps to ensure that they are in compliance with the arm's length principle and they provide enough evidence to support their pricing and the conditions of the deal. Now we'll talk about transfer pricing disputes. China's tax laws require businesses to prepare transfer pricing documentation for all intercompany transactions. The amount of documentation and the types of financial information depends on the size of the business. They refer to these as a master file, a local file, and a special file. Generally, the headcount and the total revenue of the business will determine what documents they are required to have on hand, and if requested, should provide to the China's tax authorities within 30 days. If a transfer dispute arises and the company can either not provide the necessary supporting document or are found to be non-compliant with the arm's length principle, the Chinese tax authorities have the right to make the intercompany payment non-deductible. This means that the entire amount of the transaction will be subject to corporate income tax regardless of how much profit the company made that year. Generally, there are three main risk factors that put you at risk for a transfer pricing dispute. Number one, if your company has a large amount of related party transactions. Two, if the company is continuously operating at a loss. And three, your company profit levels are significantly below the industry standard. Should you get caught up in a transfer pricing dispute, there are generally four key areas that tax authorities will look into. Number one, how each party benefited from the transaction. Second, the necessity of services in question. Number three, the rationale for determining the price. Was it done in accordance with the arm's length principle? And in the case of royalties, how much value the company derived from the use of the intangible assets? Now I want to wrap up with a case study. Assume Party A is a real estate company in mainland China, and Company B is a related architectural firm based in Hong Kong. The China real estate company pays the Hong Kong architectural firm $1.1 million as a service fee in exchange for the designing of a new building for them. They agree that the architectural firm will keep the drawings as their own intellectual property. During the course of the project, one employee from Hong Kong office spent 1 month in China visiting the build site. It is the opinion of the Chinese real estate company that because of the services carried outside of Hong Kong, and that the tax liability will be borne by Hong Kong, not in China. So the key questions are, do the services provided constitute a permanent establishment in China? And are the fees paid taxable in China or in Hong Kong? First of all, because of the employee did not spend more than 183 days in China, the services can be considered to be provided overseas. However, because of the two parties agreed that the Hong Kong firm will retain ownership of the drawings, the China real estate company is simply paying for the right to use the intellectual property. In this case, the fees paid are more like royalties rather than service fees. Unlike service fees, royalties cannot be exempted from tax liability in China if they are provided entirely overseas, and will be taxed according to the China tax law. So this is it for today's webinar. I hope that you can understand the four primary methods of repatriate profits back to the host country. If you have any question, please feel free to email us the question that you might have. Thank you and have a good day.